You own America, in my opinion.
We're talking about the S&P 500, and we have extreme concentration risk.
Why the market is back near an all-time high.
Financial literacy is not taught. It's something that needs to be taught.
Today is Thursday, May 21st, 2026, and this is The Bash. Welcome to The Bash, where we bring the analyst and player to the table to discuss relevant financial and investment topics. We're going to have 60 seconds to discuss each topic. Scott, my man, the analyst, before we get started, I like to bring something to the table here. It's getting hot out. What are your plans in the next few months? I'm sure baseball, the shore, what do we got going with the family?
I always wonder where you're going to begin with, but you just nailed it. The shore, baseball, the heat is back.
When the heat is on, the pain is gone.
I guess the heat in the market is real, so let's just get started here.
Okay, Scott, that's great. I thought maybe you would bring up the All-Star game is going to be here, but I'm sure you're going to be involved in that anyway. Our favorite thing's baseball, but let's also, of course, turn to the market. And Scott, sounds like a broken record. But the market is at or near all-time highs right now. And I think we can point to earnings growth as the key catalyst. Do you agree?
Yeah, I'm glad we're starting right there because it is the key catalyst. We've now had over 90% of S&P 500 companies having reported. We're getting double-digit earnings growth. We're actually getting a beat on higher expectations on top line and on bottom line. It's actually great to see because coming into the year, markets were still priced at a higher PE valuation. We're still up close to double digits throughout the first 5.5 months of the year, and the PE ratio has not expanded. That's because of the underlying earnings growth. What's even more important to see is the broadening out of this market. We're starting to see earnings growth in areas other than tech, and that's great. When you can get a broadening out of the S&P 500, you're going to be getting other areas that are going to start to pull the lead, that are going to be able to contribute to growth. So yes, Matt, it is a huge contributor. I hope that continues, because if not, you're going to start to see a market that has a PE ratio that is ballooned up instead of earnings catching up.
All right, Scott, we broke out the price to earnings ratio, and I'm also going to agree with you. Earnings, it's one of the pillars of the market. It's what the market cares about, and I'm going to show you why. So let's take a look at the following chart. And when you look at this chart, you can see the market and future, like we said, earnings growth is pretty much tied to the hip. Going back to 2000, look how the blue and green lines pretty much follow each other over time. And I think we've seen that recently, and we could talk about the last few weeks to a month, why the market is back near an all-time high. Because I believe that earnings, they've historically been a key driver of long-term returns, valuations, geopolitical events, sometimes market sentiment. That can be more of short-term noise, but rising earnings can suggest support for a rally in the stock market. So when I'm talking to clients or we're talking in general about the stock market and why it's at an all-time high, that feeling may not be great. I point back to the pillar here that if companies are earning money, then that is helping drive the overall market return. And that is what we see here in this chart. And that is what we continue to look at as one of the main drivers going forward.
Yeah, I couldn't agree more, Matt. Earnings growth that we're seeing right now is growth that we actually haven't seen throughout this entire bull market as well. So it is great to see. And I want to shift gears a little bit. I want to talk about diversification, because oftentimes over the past decade, it has been suggested to simply buy the market. More specifically, buy the S&P 500 for diversification.
That's what they all say.
You tell me, Matt, is the S&P 500 diversified?
Scott, I'm going to take the side of yes here because that's what I believe. And I know this is a hot topic in the investment world. More importantly, because the S&P 500 is market cap weighted, but I still believe it's diversified. And here are some of the reasons why. Look, the S&P 500 still provides exposure to what, Scott? 500 major companies, multiple industries, different economic sectors, financial, tech, consumer staples, healthcare, communications, utilities, etc. You own America, in my opinion. Now let's go back to that market cap weight issue. The best performing companies should become larger weights in the index. That's my opinion. Why do I believe that? Scott, don't winners deserve bigger representation? Shouldn't market cap weighting naturally adapt as the economy changes over time? I mean, look, railroads, when you grew up, Scott, once dominated. And then oil dominated during that time. And now technology is dominating. That's capitalism evolving. So staying invested in the S&P 500 means you'll continue to have exposure to economic growth. And one more thing, Scott, aren't many of the S&P companies multinational? That means you're getting global revenue exposure. Scott, what are your thoughts?
All right, Matt. Oftentimes we're on similar pages. On this one, we're not. And I'm not going to talk about the railroads because we're not playing Monopoly here.
Why don't we play Monopoly?
Which version? We've got Star Wars Monopoly, Rasta Monopoly, Gallipolopoly, Edna Krabopoly.
We're talking about the S&P 500, and we have extreme concentration risk. We have 10 companies that represent 40% of the overall. We have a sector that is now close to half of the overall S&P 500. So we have sector imbalance. We have extreme concentration risk. We have a market cap weighted index that creates a momentum trade, which is not diversification. That is chasing momentum. So we don't have true asset diversification as well. When you talk about international and global companies, these companies are denominated in US dollars. So we don't have diversification on the US dollar. We don't have diversification with small cap stocks. What we're also having to look at is the theory of contagion. Because when volatility spikes, correlation goes to 1. Assets tend to move together down. So when I look at the S&P 500, I'm looking at those components and how they typically correlate to 1 when we're going through a high bout of volatility. So no, I'm on the other side, that the S&P 500 is not diversified. It is comprised of the 500 largest equities that are multinational companies, but I believe true asset allocation begins at the asset class level and not specifically at the individual companies.
All right, Scott, look, it's a free country, so...
Of course, this is America.
I see.
It's a free country. Don't you know that?
I didn't know it was that free.
We accept your points there as well, and we're going to turn again to a different topic, one that I really like. Scott, let's talk about financial literacy. We hear this a lot in our everyday conversations. Do you feel that everyday investor is lacking in this area?
100% I do, Matt.
Yes, definitely.
It's not their fault. Financial literacy is not taught. It's something that needs to be taught, and it starts in schools and in universities, and it's not done. And in meetings, when we're meeting with clients, I often hear of emotional biases and cognitive biases. I hear of the fear of missing out trade, and I also see client statements when they're holding on to losers too long.
What an idiot. Oh, what a loser.
Which is called the loss aversion trade. You also may see in meetings where people tell you how their house is worth more than their neighbors and it was built by the exact same builder. So biases are real. They exist. They exist on the client level, on the manager's level. You need to be aware of what you don't know. And in my world, managing money, biases are real. I need to make sure that the portfolios that I'm implementing are clean and suitable for our investors. Matt, in financial planning meetings, what are you seeing?
All right, Scott, you gave some good advice, and I do believe that there's a lack of financial literacy. So we do agree on this. And I first want to turn to statistics. So according to the TIA Institute, GFLEC Personal Finance Index, yeah, that's a mouthful, U.S. adults answered only about 49% of financial literacy questions correctly in 2025. Think about that. The average American essentially failed basic financial literacy. Also in 2025, the Federal Reserve released its annual report on economic well-being of U.S. households. One of their key findings from 2024 data, only 35% of non-retirees view their retirement savings as on track. That means nearly 2/3 of workers feel financially behind. Ground up education, there's a lack. We are not teaching in school, in my opinion, debt management, compound interest, details of insurance, creating a budget, etc. We're learning how to do many other subjects, which is great, but when you're coming to the real world, this is where we're seeing a major lack of literacy and definitely should be changed going forward.
Matt, I love those statistics. I couldn't agree more with that answer. And now I want to shift gears again. And look, I'm going to say it right now, we're way too early to be talking about the midterm elections, but it is, 5 months away at this point. So let's get into it, but let's talk from a historical perspective. How have midterm elections historically affected markets?
Scott, I know you wanted this. Affects the market. And if it's okay with you, I'm going to turn to another chart. And this one dates back to 1950. So when you look at this chart, I really want you to look at the second part of the cycle, the midterm. Yes, you see the orange showing that the total return can be very high after lows, but look at the blue. See how it goes down the most during that second year? That shows there's potentially a lot of fluctuation or volatility in the stock market during that midterm year. Scott, on that, I want to give you a couple reasons why I see this. Presidential cycle, it's the second year of the cycle, and historically it's been the weakest. Possibly because the fading of the economic boost from prior election cycle. There's fiscal battles in Washington. They could be increasing. Or on top of that, Scott, investors could be pricing in the probability of a divided government or policy reversals going forward. So that's where I'm seeing a lot of that volatility in that second year during that midterm election. How about you?
Well said, Matt. And we just spoke about financial literacy, right? One of the most overlooked areas of financial literacy is understanding that volatility around elections is very normal. Why? It's the creation of uncertainty. What's the one thing the market can't handle? Uncertainty.
The uncertainty principle. It proves we can't ever really know what's going on.
When you have uncertainty around policy, we don't know where the shift is going to happen, whether it's around taxes or regulations. That uncertainty is what the market is grappling with. When the discussion or the debates go back and forth and they are very emotional, another one we just spoke about, that's going to move the markets. 2018 midterm election years, peak to trough sell-off, close to 20% in Q4. Historically, since 1950, midterm election years have a peak to trough correction of 10 to 20%. Investors should buckle up for uncertainty. And that uncertainty should provide an opportunity.
Wow. So I hear buckle up. We're going into the summer. We covered a lot here at the midterm elections. There's a wars going on right now, but we're still at or near an all-time high, and we summarized that today. Scott, anything else we missed or you want to add for today?
Matt, there's always a lot going on when we're having these videos, but I hope everyone had a great Memorial Day this past weekend with friends and family, and looking forward to a very fun and great summer.
All right, Scott, I think you said it all right there, so I'm going to keep this simple. Don't forget to stay focused, stay disciplined, and stay tuned for the next episode of The Bash.